So let's look at the relationship between business risk and financial statement risk. Now, financial statement risk or risk of material misstatement include both inherent and control risk. We looked at that in the earlier session. And financial statement risks are generally the risk that the assertions on the financial statement may not be correct. So management sets some particular objectives they want to achieve over the financial statement, like occurrence, existence, valuation, cutoff, and others. So business risk, on the other hand, is a risk that the business may not achieve its objectives or may not achieve its cash flows. So, for example, any factors capable of eroding or reducing the profits of an organization constitute a business risk. So any factors that threaten the going concern of an organization equally constitute the business risk. So we can identify such risk by using pestle analysis, five forces analysis, and it can be grouped into compliance risk, financial risk, and regulatory risk. So the presence of business risks make the financial statement susceptible to manipulation. This is because business risks put management under pressure. So management will likely want to hide the effect of these business risks from the shareholders. And this would make the management to manipulate the financial statement. So these are some specific examples of business and financial statement risks that you have to note. First of all, a highly geared company. You know that if a company is geared, it is faced with financial risk. And this is because the huge financial commitment involved, interest payments like this, will reduce the company's profit and as such, it constitutes a business risk. And some of these may also impact the financial statement because there might be a revenue risk involved because interest has a tax shield and it may reduce the tax. This may equally lead to a going concern problem in the future. Okay. So also a business that requires a license to operate also poses a business risk. The business here is that non-renewal of the license as a result of not meeting the attached conditions. If the license is not reduced or renewed, the business will not be operative. So the associated financial statement risk is the non-disclosure of going concern problem in the financial statement. Also, another business risk is a company that is listed on the multi stock exchange. So a company listed on a multi stock exchange is inherently risky to audit because the reporting requirement on each exchange differs. Also, a company that operates in multiple locations also poses a risk. So the presence in multiple locations also increases control risk in that the entity system of control may not cover all the locations. As I was saying earlier on with inventory valuation also becoming a problem. So it equally increases detection risk in that the auditor needs to attend and obtain information from various locations. So you can have also retail businesses which have risks like transactions tending to be high volume and low value. Transactions are often carried out in cash. Trade receivables are likely to be immaterial and therefore have low risk. It is difficult to also establish completeness of income, and the risk of theft is very high. Okay, so that are some of the risks associated with retail business. Then we have industry specific risks, like companies operating in specific industries that make use of complex assets that are difficult to value. Like companies operating in the mining and oil and gas sector have some peculiar or tech sector with peculiar or specific patents and trademarks and specific or unique intangibles that are difficult to measure. So, what are some of the hints or answering questions of business and financial risk? So, if you are provided with extracts on the financial statement and they are asking you to find some business or financial risks, you can perform analytical procedures for the following. Look for movement in revenue, movement in finance costs or interest expenses. You can check movement in gross profit margin, net profit margin. The percentage increment or decrement of the following pair of items should ideally be fairly the same. Okay, so compare the percentage changes in the items and explain any variance with a possible misstatement. Okay, so the percentage change in sales revenue versus the percentage change in cost of sales, the percentage change in sales revenue versus the percentage change in material expenses, the sales growth versus the trade receivables growth, change in trade payables, and change in material expenses. So compare these and draw conclusions and investigate the differences. So companies with overseas branch, so there are some risks that should be identified like foreign exchange risk, tax complication, tax complication as a result of the company not understanding the foreign tax system. And when customers are dissatisfied for whatever reasons, the following risks are possible. So they can damage your reputation, and this may lead to brand impairment. And you may have drops in revenue, which may lead to going concern problem. So some of the areas that are subject to manipulation in the financial statement may include inventory, where valuation might be wrong. So inventory may not be valued at the low of cost and NRV, and you may have contingent liabilities and provisions which may not be disclosed where required. And provisions may be understated or not made at all. So these transactions do not translate or comply with the IAS 37. Any intangibles may also be overstated or wrongly classified as against the provisions of the IAS 38. Impairment reviews may not be carried out in compliance with the requirements of the impairment standard IAS 36. Then lease assets may be wrongly classified and the lease obligations may not be recorded. And we could mostly have this under off balance sheet financing. That is why the new lease standard has come, IFRS 16. So let's look at how non routine transactions, judgmental matters also impact and bring about audit risk. So, what are non routine transactions? These are transactions that are unusual due to either their size or nature and that occur infrequently. So reasons on account of which risk of material misstatement is increased on account of non-routine transactions. So because they don't occur most of the time, like buying an asset doesn't occur all the time, opening a new branch does not occur all the time, a huge contract does not occur all the time. They occur infrequently. So what are some of the reasons that these ones may bring about audit risk? So one, there's greater management intervention to specify the accounting treatment of these items, and there's also greater manual intervention for data collection and processing. There are complex calculations for accounting principles, and the nature of non-routine transactions may make it difficult for the entity to implement effective controls over the risk. Now, what are judgmental matters? Judgmental matters may include the development of accounting estimates for which there is significant uncertainty in its measurement. So, these issues require judgment, like looking at intangibles, property and equipment, fair value measurement. There are a lot of standards that have or accounting treatment that require a lot of judgment. So reasons on account of which risk of material misstatement is increased on account of judgmental matters. So we may have accounting principles for accounting estimate or revenue recognition. There are different interpretations for them, and also required judgments may be subjective or complex, or they may require assumptions about the effect of future events. For example, judgment about fair value, as I was stating earlier. Okay, so we have large and unusual questionable items, which depends on how you are looking at. Okay, so this will depend on the auditor's perception of the return as a whole, the financial statement as a whole, to determine what is large, unusual, and questionable. Okay, so to determine what is a large, unusual, questionable item, you have to look at the comparative size of the item, the absolute size of the item, the inherent character of the item, the evidence that has the intent to mislead, or evidence with the intent to mislead, relationship with other items like reported sales, but there's no capital gains tax returns, and whipsaw issues, which are factors that occur when there's a transaction between two parties and the characteristics of that transaction will benefit one party and harm the other. Examples may be an alimony versus child support and others. So missing items should also be considered, and other internal sources of data can also help us to identify large unusual questionable items. But we'll look at it in detail when we do analytical procedures. Now, let's look at materiality and how it relates to risk assessment. So auditors need to set materiality for risk before conclusions could be drawn. So an item is material if its omission and misstatement would reasonably influence the decision of the addressee of the auditor's report or the user. So auditors consider materiality at two levels: the account balance level, which is done at the planning stage to guide the audit staff, and overall financial statement level, which is done at the review and reporting stage to assess the truth and fairness, or assess the effect on the truth and fairness or the impact on the audit that we are doing. So what does materiality depend on? or dependence of materiality. So auditors will need to assess the materiality of transactions and risk at various stages of the auditing assignment. So what may be material in one instance may not necessarily be material in another instance. So it depends on several factors. Some of these dependents are the size of the item, the influence on the user, the nature of the transaction, the size of the business, the nature and extent of audit procedures to be carried out, and so on and so forth. The complexity of the business as well. So, as a guide, percentages are sometimes used to determine or create materiality. So, auditors often use percentage as a guide in determining what will need further investigation, explanation, or disclosure. So, an example may include 0.5% to 1% of turnover, 1 to 2% of total assets, 5 to 10% of profit before tax. Okay, that is to set your materiality. These are the thresholds or the benchmarks that may be used. So let's look at the implementation of materiality and risk on audit planning. So if audit risk is high, the likelihood of detecting material misstatement is low because you think the audit risk is high. So even though material misstatement exists, the auditor may miss them. So what action shall the auditor take? So he might increase the sample size, increase the substantive testing, and increase third-party evidence or confirmations. If audit risk is low, then it means that there's less chance of misstatement in the assertions. The auditor may therefore reduce to smaller samples and, if possible, rely on the client's system. So this brings us to the end of audit risk.